Hello, I'm Richard Bossard back again. I'm your certified and experienced expat tax consultant, and I do work for much lower fees than the CPA accountants and the tax lawyers who do work that's very good for corporations and wealthy people, but I can help the normal person on a one-to-one basis and still cover all of the things you need to know to legally get out of any U.S. um, any tax liability. Today I'd like to talk a little bit about that famous form TDF 90-22.1. That's the Treasury report that must be made concerning your ownership or control over any foreign bank accounts. Now, I don't want this to scare you, but first of all, the report on these bank accounts theoretically is supposed to go in on April 15th, even though you have an overseas deadline for filing of June 15th or even later with an extension. However, I have never done that for my clients. We usually send in the TDF form together with the regular tax form, and there's never been any recourse or complaint from the Treasury Department. Of course, they're looking for the big fish, the few people out of hundreds of thousands and millions of Americans overseas who suddenly have a windfall income like playing baseball or something and want to hide their income overseas, and that's the purpose of it. Most normal people are carrying on normal bank transactions, even though I do a lot of clients in Switzerland, and of course, Swiss bank accounts has become a very notorious subject, but it is in 99.5% of the cases quite innocent and used for normal banking purposes. The other part of this that I want to talk about is the fact that currently the IRS is trying to scare even more people overseas, I believe, by sending letters to all foreign banks and saying that anybody who has an estate settlement, whether they are a U.S. citizen or not, but have shares in American companies in their bank accounts, that these are subject to U.S. federal estate tax. What is reported by the media is the fact that the tax rate goes from 0 to 35% over an estate value from 0 to $500,000. What they don't report on or overlook, and I have seen that letter sent to the banks, is the fact that if you are an American citizen, the first $5 million of your estate value is exempt from estate tax. If you are not an American citizen, you have an exemption of the first $60,000 of estate value. So that puts a little bit different light on it. But the panic raised by the media has caused hundreds of people to run to their embassies overseas. These are the dual citizen types, and they want to renounce their American citizenship. I think that's a serious mistake. And from the tax standpoint, if you exceed a certain level of assets or income or both, you may be required to file a tax return anyway for the next 10 years. And that's to catch the people, who go over with a big amount of money and resign their U.S. citizenship to try to avoid taxes. That's not the case for most people. However, if you don't file for those 10 years, you might say, well, so what? I'm no longer a U.S. citizen. But don't ever try to enter the United States or they'll grab you, and it's a criminal offense. So play it cool and just go on as if nothing had happened, because these are pretty rare instances. I do now have one client who expects to inherit $1.5 million and part of a house from his mother due to a change in the tax law in his country, and he's a dual citizen, and he is worried about any U.S. federal estate tax obligation. But there again, as a U.S. citizen, he has the first $5 million for the tax year 2010, which is new, that can be excluded first. We don't know what's going to happen in 2011. Maybe the super committee of 12 will change all the tax rules again, but we'll have to wait to find that out. Thank you, and if you need more information or help from me, be sure to click down below on the link to my website, and we'll go from there. Thank you.